U.S. natural gas futures slipped to around $3.03 on Tuesday, a three-week low, as mild weather forecasts and strong storage levels eased worries about supply tightness. Updated projections indicate warmer than normal conditions lasting through late October, tempering expectations for early heating demand. Meteorologists noted that meaningful cooling is unlikely to develop until the final week of the month. The 8 to 14-day outlook continues to show no strong cold signals, keeping demand expectations subdued. Although some cooling appears on the forecast maps, it remains too weak to significantly alter market sentiment, while the sparse occurrence of 90s across the south offers little support for late-season cooling demand. Although prices are hovering near the lower end of their recent trading range, the overall fundamental outlook remains firmly bearish. U.S. production, while marginally below its 30-day average, continues to operate at historically high levels. Looking ahead, marketed natural gas output is projected to surpass 118 billion cubic feet per day by 2026, driven by stronger than anticipated gains across key producing regions such as Appalachia, the Permian Basin, and Haynesville. At the same time, infrastructure expansions like the Mountain Valley Pipeline are enhancing takeaway capacity in the Northeast, allowing producers to move greater volumes to market and further reinforcing the oversupplied backdrop. It's therefore not surprising that the fair price for December now sits below that of November, reflecting the market's growing skepticism about near-term demand strength. This downward adjustment suggests traders are anticipating continued oversupply and mild weather conditions heading into winter. If this trend persists, we could soon see a scenario where futures prices converge with the fair value level observed back in August, dipping once again below the $3 threshold and signaling a renewed bearish phase for the market. From a technical perspective, the bearish chart setup remains intact, with prices struggling to stay above the $3.10 mark. Key support levels are seen around $3 and $2.90, and a decisive break below these could trigger deeper losses. On the upside, resistance is positioned near the $3.20 level, where previous recovery attempts have stalled. The broader trend stays bearish unless prices can reclaim and hold above this level, signaling a potential shift in sentiment. Overall, both fundamentals and technicals suggest continued downside risk for natural gas in the near term, with any rebound likely capped unless colder weather or a supply disruption changes the balance. Don't forget to drop a comment, check out the last video and support the channel. Catch you in the next one.